there's a push, I believe, to reintegrate gold, Andrew, into the monetary system. And that's why it's slowly bubbling higher. The question to me really is, how high does it go on its own? And will they, in essence, choose to revalue it the way that Roosevelt did in 33 and the way that Nixon did in 71 or 72 and 73? After he closed the gold window in 71, he did revalue gold the next year by about 7 or 8% by devaluing the dollar and pushing gold from 35 to 38. And then in 73 from 38 to 42.22. Gold revaluation is not a new phenomenon. And who would it benefit? Well, it would benefit all the central banks. So I think numbers higher than most people would consider to be prudent to say publicly is realistic.
AndySchectman, CEO of Miles Franklin, notes that the world is witnessing a coordinated and quiet move, particularly by BRICS nations and China, to accumulate gold using various strategies. These include not only traditional purchases through exchanges but also off-market acquisitions such as doré bars, which are semi-pure forms of gold typically sourced directly from mining operations. This form of accumulation bypasses the visibility of traditional financial markets, suggesting a deliberate and strategic reintegration of gold into the global financial system. In a record-setting month, Asia accounted for 65% of total net global gold inflows, while demand in North America remained strong and European markets experienced negative flows. The People's Bank of China allowed select banks to purchase foreign currencies for gold imports as prices surged amid U.S. trade tensions under President Trump. Schectman notes that while gold's rise has been underreported, central banks are positioning themselves for a future where gold may regain its monetary role. The key question is whether gold will continue to rise gradually or undergo a dramatic revaluation, similar to past moments when its official price was adjusted. In the current market, gold continues to show resilience, holding support above $3,300 an ounce despite increasing pressure from shifting global economic sentiment. Analysts note that while the metal briefly reached a high above $3,400 this week, it ended lower, showing signs of fatigue. However, it is notable that gold has recovered from the previous week's drop to $3,200, indicating that underlying support remains intact. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think that picking a number is very challenging. Of course, you have Goldman Sachs saying as high as $4,500. You have other mainstream pundits saying 3,700 to 4,000 in that range, talking about gold reaching a level, in the thousands of dollars higher than where we are right now is not that outlandish. First of all, if we were to look at the United States becoming a net importer of gold, I don't ever remember it being a net importer of gold. There were 1 or 2 years where we did have net imports, but not like we are seeing now, where, more gold has been imported to the United States since January than at any time since the end of World War II, when we took over for the pound sterling at the Bretton Woods Agreement. Everyone sent us their gold. Something big is happening with gold. And of course, you see Trump's tweet the other day on Easter Sunday. He says, the golden rule of negotiating success, he who has the gold makes the rules. Thank you. You see talk of revaluing gold, which was held in the gold revaluation account. That's actually the name of it, which you can't make up, whether it be the head of the Bundesbank or the Dutch National Bank or members of the governing board of the Bundesbank or Senator Loomis from Wyoming, all talking of gold revaluation, whether we talk of Judy Shelton, Trump's former nominee to run the Fed in 2016, who advocates for 50-year treasuries backed by gold, or the Treasury Secretary currently of the United States, who largest holding was gold while running a hedge fund and prior to becoming the Treasury Secretary, and is a self-proclaimed gold bug. There's so many things happening that make you wonder and think. Now, to Jan's point, it would certainly benefit the United States and all the central banks to see gold revalued to a much higher level, whether it be by the market slowly, as we've seen slow and steady, tremendous appreciation that's gone unnoticed by the mainstream, which is really shocking to me, which tells me we're still very early in the game, or something more dramatic where, they come in and revalue gold. Every $4,000 increase in the price of gold gives the Treasury General account $1 trillion free and clear. So, you see gold at levels of 4,000, 8,000, 12,000, whatever that number is, at $12,000 an ounce. And I think that's the number that James Rickards came up with. You're giving $3 trillion free and clear to the Treasury General account. I did a little bit of math myself after watching a great video by Mike Maloney the other day where he talked about gold. Mike Maloney's video talked about when gold was backing the currency prior to 33 over my shoulder there. It was just backing M1, which is the notes in circulation. M2 is a broader measure of the money supply. They got rid of M3. They said it was archaic. So currently the broadest measure that we have access to is M2. And that's largely credit. It's 92% credit. So when you look at your bank account and you see $50,000 in there, that's credit. That's M2. The bank owes you the notes. You know, they promise to pay it to you, but M1 is the currency in circulation. M2 is only 8% currency, 92% credit. So when gold was backing the dollar prior to 33, it was backing M1. If you take M1 right now, 2,365 billion and divide it by the 261 million ounces we supposedly have, you get $9,044 an ounce. Could that happen? Yeah, why not? I mean, why not? Why not revalue gold to a level high enough to start to whittle down the debt and benefit the central banks on the planet who, for the last, really since 2017, have been on a binge buying and repatriating, and largely because of many of the things that you've talked about for years that enlightened me, namely the reclassification of gold, the tier 1 status, and the importance of owning an asset that has no counterparty risk. The way that the mechanism works, in essence, is if you had gold at $8,000 an ounce, the Treasury would issue gold certificates to the Federal Reserve. The Federal Reserve would, in essence, just create that money and give it to the Treasury General account. They now would have, at 8,000, they would have $2 trillion free and clear to do with as they see fit. Those certificates do not give the Federal Reserve access or a call on the nation's gold. It's the fiat equivalent of it. So it's kind of an accounting gimmick, to say the least. So I guess I would just simply say this. Something is very different with gold. There is no question about it. When you see the massive amounts of gold imports into the country, when you see the massive amounts of imports to the BRICS nations, the continual drive to repatriate and accumulate gold on all levels, using all different techniques, even flying around the world as China is doing, buying doré and concentrate to disintermediate the marketplace. You got the largest producer of gold in the world and the second largest producer of silver flying around the world buying doré and concentrate, so no one knows what they're doing.
AndySchectman highlights a growing global awareness of gold and silver as reliable, counterparty-free assets, increasingly seen as the foundation for a more trustworthy and stable monetary system. This recognition marks a shift in mindset, especially outside the West, where the transition toward asset-backed and physically settled financial frameworks appears to be accelerating. While Western financial systems attempt to navigate and manage this evolving landscape, the global momentum seems firmly set on returning to more transparent and physically grounded market structures. This shift is evident in recent activity reported by the London Bullion Market Association, LBMA, which announced that gold held in London vaults rose to 8,536 metric tons at the end of April, representing a 0.6% increase from the previous month. A significant portion of this gold returned from New York, signaling a rebalancing of physical supply after a period of dislocation between markets. At the same time, the premium of the most active COMEX gold futures over London spot prices, which had remained elevated for months, normalized in April. This adjustment coincided with the Trump administration's decision to exclude gold from broader U.S. import tariffs. Before this, market participants had rushed to deliver gold into the U.S. between December and March, hedging against the risk that tariffs might extend to precious metals. The normalization of premiums and the return of gold to London vaults indicate a broader realignment of the gold market toward equilibrium, driven by both geopolitical developments and structural shifts in how gold is traded and stored. Let's get back to the interview.
You know, there's talk of the BRICS metals exchange, but, you know, and I think you'll agree what's different over the last several years at any time I've been watching the markets is the delivery, is that most contracts usually never stood for delivery. We didn't see much in the way of delivery, and maybe 1% of contracts or so. And that really since 2020, that number has exploded higher and continues to go higher around the globe. But last year or the year before, the BRICS talked about the BRICS grain exchange, which is something that is in development right now. And the fellow that's running it came out and said something very interesting as far as I'm concerned. And he said, you know, the countries in the BRICS nations produce and accumulate and consume more wheat than they do in the West. But we can't control the price, he says, because that's controlled on COMEX. And with the development of the BRICS grain exchange, that will change. Now, if you don't think they understand that about the metals exchanges, I got a bridge to sell you. And they do understand this. And so this has been a methodical, slow bleed down. And a lot of people in the West have a hard time understanding why they just don't throw the kitchen sink at it and buy everything that they possibly could. But it doesn't work that way. The whole system would just implode. So instead, they have been slowly and methodically draining the system and bleeding it down, and understand that the pricing is controlled on COMEX, where in the snap of a finger, they can make oil negative 40 a barrel. Well, that's the futures market controlling the physical market, and that's not the way it's supposed to be. My guess is that there will be a move to centers like Dubai, centers like Moscow, centers like Shanghai, or this new BRICS metals exchange, ultimately, which will define the price. And I think the West is being exposed for what it truly is, a system that, is controlled by a handful of Western bankers, and it doesn't do any favors to not only the folks that accumulate commodities and understand what they are, but even more so to the folks that produce them and distribute them. And my guess is that, look, you can only manipulate a market over an extended period of time, as we've seen, by pushing it in the direction that it is going. For many years, no one wanted gold and silver. That's changed. I really do believe that metals are now being looked at very differently as the foundation of solid, stable money free from counterparty risk. And that carries a lot of weight. And I think that is a trend we are moving into. And to try and hold back this global tsunami of demand is as stupid as a mud wall. It represents an existential threat to a lot of these banks, a lot of these funds that have chosen to go naked short. And if they were smart, they would do all they could to pull themselves out. I think some of them are. But yeah, I think real price discovery is something we really haven't even experienced yet. And when it moves to a cash settlement where T+1, like in Shanghai, like it's supposed to be in London, where you pay your money and you get your metal and off you go, that's going to change things very dramatically. It seems as though we're moving in that direction. And it seems as though, as much as I have a hard time even saying it, that the folks on COMEX understand this and are moving to clean up, if you will, the mess that they've made for all of these years, because very, very quickly, this can turn pear-shaped if you see a large group of entities stand for delivery and they're not able to come up with the metal. Everything immediately blows up, kind of to your point. So yeah, I would like to hope that the Trump administration has gotten wise to this, and that moves are being made to kind of get the house in order leading up to July 1st.
A global recalibration of the monetary landscape appears to be underway, with a notable pivot toward tangible assets like gold as trust in traditional financial systems erodes. From strategic off-market acquisitions in Asia to shifting vault holdings across continents, these developments reflect a broader movement toward financial sovereignty and transparency. Amid geopolitical maneuvering and trade policy adjustments, the metal's sustained strength underscores its emerging role as more than just a store of value. It's becoming a cornerstone of an evolving economic framework. As gold quietly reclaims its influence in monetary affairs, the question arises, are we on the cusp of a new global financial order anchored in physical wealth and reduced reliance on fiat structures? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.